Hey guys, welcome back to the channel. In today's video, we're going to be talking about unemployment and also the Federal Reserve. So if you look at the US economy as a train, the Federal Reserve is the conductor of the train that we are riding. Kind of a funny way to think about it, but the interest rate is what really drives the economy faster or it drives it slower. Now, there are a couple things that they can use that we're going to go through to really lower the interest rates that are going to inflect inflation, going to really impact unemployment, going to impact anything that is variable, including some of the savings accounts, CDs, credit cards, HELOCs, home equity line of credit. Everything is going to be determined by what the Federal Reserve continues to do. Hey guys, welcome back to the channel. In today's video, we're going to be talking about employment and the US economy. Now think for a minute that the US economy was a train. The Federal Reserve of this is the conductor for this train. Interest rates are really the lever to increase or decrease the speed and really the velocity of this train. Now, looking at that and thinking of that analogy, guys, the Fed has a really difficult decision to make. We know that they just raised interest rates another 0.25%. They're trying to get unemployment much higher, which is going to, of course, impact the ability for people to pay. That is the reason why they want to go ahead and drive this train a little bit faster. We just have to make sure that the rails stay on the train, guys, because all in all, the interest rates also in fact affect the savings accounts, CD rates, the banks that are paying higher interest rates. It also affects the bond yield, so the percentage that we're getting for bonds, but it also affects credit cards. Anything that is adjustable rate has seen the rates literally go through the roof. Even from looking at an auto loan perspective, it was at 1.74 almost a year ago. Now you're looking at almost 6%. So if you're looking at an auto loan, you're looking at 3 times the rate that you paid for an auto loan. Now, the decisions to really control this are very difficult because if there is a 0.25% raise, if there is a 0.25% lower, you also do have the stabilization of the economy in looking at the growth of the economy, looking at a recession, looking at a really tough labor market. There are so many things that can be affected with what the Fed is doing. Now, there's a quote in this Bankrate article. It says, "Inflation is the fire that has been ravaging households' budgets," which I absolutely agree with, guys. Inflation has been burning through the consumer price index, absolutely crushing budgets nationwide. The Fed has to put out the fire, can't hold back because they're worried about water damage. Now, this is something that Powell has talked about before. Regardless of what the economy is doing, they still have to be in charge to go ahead and really stabilize prices, keep unemployment at an acceptable level, while not allowing the price market to just burn up like we have kind of seen. Now, the Fed's fund, or the Federal Reserve itself, is really in charge of the interest rate, the Fed's fund rate. Lowering interest rate is to combat jobless with the acting stimulating growth. High borrower costs have the opposite effect, which is what we're seeing right now, guys, is the borrowing cost got to a point where it was no longer acceptable. The economy was on fire. A lot of that, unfortunately, is because of the Federal Reserve or because of the United States government, really, giving multiple stimulus packages where unemployment shot up through the roof. The spending never stopped. When COVID happened, again, the unemployment, if you look at any of the graphs, if you look at anything, went through the roof, but people still had the ability to borrow or buy or even buy more than they ever could because they got the stimulus packages. Now, they're also looking to maximize unemployment. Is currently thought of as 4%. The maximum employment per the Federal Reserve is 4%. Right now, we are a little bit under that. And again, when you give the people the ability to hold jobs, make income, earn more income, and then top all of that off with the ability to buy, that is the reason, again, the Federal Reserve, why they want to increase when it comes to the unemployment rate and really get that under control. As of right now, the Federal Reserve is trying to get to about 2% inflation, which a lot of people are saying that we are very, very, very far away from that. I believe the last inflation numbers were 6.4%. They're also trying to get the jobless rate below 3% for people 20 years and older, which again, that is kind of out of whack. So when you look at the Fed's fund rate, when you look at the CPI index, when you look at literally all of the indicators within the stock market, the Fed's increase is working. It is doing exactly what it's supposed to do, guys, as they slowly creep up the interest rate. The problem is we have seen an unprecedented amount of interest rate hikes in a very short amount of time. So we do not know the full impact of what raising it this high, this fast is going to do. But again, they are there to fight inflation. They're trying to get really the CPI down. So why does the Fed really care about inflation and really care about unemployment? Both inflation and unemployment have massive impacts on the wallet. When unemployment is low, it's easier to find a job so people can spend more money. If inflation is high, the dollars in your wallet won't buy as much as they did, diminishing your purchase power, and that's exactly what they're doing right now. Yet, there are a lot of other corners of the economy that really make a big difference, guys. One, of course, is the centralized banking system that they have in place. When you look at the cost of bonds compared to what they're able to buy them at today, there's a big discrepancy above those. But also when you're slowing down the economy, you're slowing down manufacturing, real estate, financial, stability, trying to get the consumer spending under control makes a big difference when you're coming to these points. Things like household income, subcategories of spending, unemployment in particular sectors or behaviors or asset markets or financial markets, they are very hard to kind of measure, and they have different targets and different things that they're actually measuring. So when you look at, again, the interest rates that have went up as of March of 2020, it has been the fastest interest rate increase that we have seen in history. That is really the big thing. A lot of people disagree with how everything is being run and how things are being kind of handled. A lot of people agree that we need to kind of be more aggressive with it, which I don't really agree with. I think we need to slow it down a little bit, but still keep it under control is the big thing that I see, guys. Because again, if you continue to raise it as fast as it goes, there's going to be a point where people just quit buying things. And that is really the bottom line that we can see here. Everyone cares about how much they can buy with their wallet, with their dollar. You wouldn't want that money, and you wouldn't want to buy goods and services if you feel they are really overvalued or just really overpriced. All of this shows just how important the stability within the economy is. And that's, again, what they're trying to get to, guys. They are trying to get to that 2%. Right now, again, we're at 6.4. So we are very, very high when it comes to where we are as far as the interest rates at the current time. Removing the ability to buy things. Too high of interest rates, they cool inflation, but they also have a very big risk of slowing down the economy more than we need and leaving a lot more people out of work. If you've seen the news, probably within the last 6-8 months, everybody from, Meta's laying off 10,000 people. You see Google's laying off people. You see literally everyone kind of across the board doing some sort of staff reduction to really combat the cost that everything is really running at right now. And that's, again, another thing that they're really trying to get under control. Uncertain economic time, guys, this is when you prepare your finances for a recession. I'm going to put a link to the video right up here. Definitely looking at it, guys. You can and you really need to recession-proof your finances. It is one of the really big things that you definitely need to focus on. It has to be done. And regardless of anything, guys, cutting your spending makes a big difference. Saving more money makes a big difference. Even having more money in cash, again, makes a really big difference. All right, guys, so that'll do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching.